AAL, American Airlines Group. So let me let me take a look at American Airlines, and then I'll jump on the market. There's a couple of things happening today so far. This is not even really pre-market yet. This is more of overnight trends following up from yesterday, just to try to set up for today. Um, but American American Airlines. So I have a playlist for like a bankruptcy watch playlist, solvency watch playlist. And American Airlines is now doing is now doing more crazy stuff. So they've started downsizing the company a little bit, and we'll see the at the end of this month, the PPL loans and everything are going to expire. So we're going to start seeing companies able to lay off people that they've been holding on to because the government's been paying them not to lay people off. But American Airlines is going beyond that. They're issuing new shares, they're diluting stocks. They started issuing bonds to try to raise money. They started issuing bonds a while ago to try to raise money. And now they issued a new set of bonds about a week ago at 11%, and now they've just issued even more bonds at 12%. So the bond risk curve is increasing, and um, just in general for the airline stocks, like American Airlines has the famously terrible balance sheet and the most debt. And so, I mean, they're just burning cash right now, and they're trying to stay alive. And so, it's a look as to whether they can restructure without bankruptcy, or if they're going to have to use bankruptcy in order to restructure the company. Um, and in the case of bankruptcy, even like a Chapter 11 bankruptcy, like their liabilities are greater than their assets, so they're negative. You call it the book value, like negative book value. But in the case of a Chapter 11 bankruptcy, like the equity shares of the stock is is immediately worthless. And so right now, if they're able to raise all this cash, that should be enough cash to float them pretty much to the end of the year. So we'll see if they're able to raise that much cash. But this stock is definitely a hot one on the bankruptcy watch list. And so they've already kind of had this little hyper bubble peak and reversal here. And so this solvency situation could be dragging them down slightly over the next year. But we'll see if they can raise all this money and start to restructure. Uh, I don't know what the stock will look like if they're able to actually restructure. I don't know what to expect in the stock, but if they're not able to restructure, it's pretty obvious this thing is just going to trend down to zero. And then we had one. Well, let's just jump on the S&P and take a look at kind of the trending stuff. So we're in this channel right now, kind of in an expanding kind of boring channel. And so yesterday we didn't make it out of here. We got rejected and finished down. Just kind of weak overnight action. So this is just weak. The momentum's looking weak. Let me flip through the momentum here and see what we're getting. So out on the daily, we're still in bull territory. Out on the 2-month kind of look here, and we're trending down, but we're not trending down steep enough to be like a really bearish move. Because a bearish move the blue line needs to separate far enough away from the red line to actually pull the red line all the way down onto the bear side of the momentum here. So this is pretty neutral momentum. We're pretty high in bull territory, and we're starting to make a bear. It's neutral right now, and it hasn't made a real bear move yet. It's starting to try maybe, and then this is a little bullish, on the last couple days or 4 hours, like 2-week kind of outlook. So yeah, this bull move has put the shorter terms charts back up into bull territory, and now it's making a tiny down move. It's kind of neutral. So that's kind of where we are on the charts. We're in a bullish kind of spot, maybe making a bear move. And so, I guess making more of a bear move right now. The pre-market stuff's starting to come in, and uh, it looks like a big red candle right now. So yeah, so this is going to be actually should be more of an interesting day. If we get like a sell-off to open, I was kind of thinking of a target in the middle of this range for the whole day. If we put in a nasty red candle right now before opening, we might. Well, anyway, we're just kind of in this range and we're just kind of crossing it right now. So, I mean, it looks just kind of weak, and just generally like the down moves are usually sharper than the up moves. So if it starts to turn down, I mean, it's pretty easy to cross this range again. And that's what I was looking at over, maybe the next couple of days, to kind of look for a down move to kind of cross this range again. Just because we failed to get any kind of a breakout signal here to move up. So yesterday, yesterday on the up momentum, I wanted to see if we're going to get kind of a breakout move. And on the general model, like we have these two really monumental kind of trend lines here. So this is a 2-year long support line that supported the sort of the hyperbolic run off the bottom of the 2018 crash, and this yellow line down here is a 12-year trend line that supported the whole bull market off the bottom of the 2008 crash. And so we're just kind of in the middle of nowhere right now between two major trend lines. And so being above this trend line means that we haven't really broken into a long-term bear market yet. And being below this line means we haven't broken out into an actual bull market yet. And we got a huge rejection here off of this top trend line. So that's setting up the potential for a bear market reversal here. But since we didn't follow through, I was looking to see if we're going to get back up towards this trend line. And now it's just kind of dead momentum in this range. So I mean, that's really all I'm looking at today is just to kind of stay in this range, and it looks, a little more bearish. It looks a little more bearish to open, but that's it. Just kind of a weak and boring day. There's not much going on. On the let's take a look at the Japanese yen. So this is one of the commodity pairs that's been really interesting because the yen dropping preceded that S&P drop here. And so the currency pairs have been trending with the S&P for the most part. Like if you look at the DXY, it has been just pretty much doing the opposite of the S&P. This down move was an up in the S&P, and this uptrend was a down in the S&P. So this is we get the down candle in the S&P right now early, and we're getting a little up candle. So this is all we can really see right now. It's early before even the European markets are opening now. But yes, we're getting a down candle on the S&P, a little up candle on the DXY. So this is signaling. It's signaling kind of a weak day. Just as like a little breakout kind of movement, if you want to guess on the direction that'll go today. But the yen has been preceding these moves, and it just did a big move down yesterday, and so that's a weakness signal that already happened, and that's really the only good one that we have anything to see right now. But I am really interested to see a red candle right now off market because 90% of the off market activity over the last 3 months has been green, green, green. And then the daily trading has been relatively neutral. I mean, slightly green, but not anything relative to the shape of this bull run. Like most of the bull run has happened off market, which is really interesting. And so just trying to figure out who's trading all the off-market stuff. And when the off-market is bearish, that usually is pretty bad. The green off-market stuff, when we get a lot of sideways activity, you get green off-market and sideways activity. That's what we have been getting a ton of. But the red off-market stuff has gotten more red most of the time. So I see it. I mean, I see it possible to kind of cross this range, and that's a big move, even though it doesn't seem that big right now. I mean, these are huge moves. I mean, just like this little range here where we're swinging whatever it is, 1 or 200 points on the S&P, like those are moves that usually take like a month, and that's like our daily target here on the downside. And I don't think it'll get down that far today, but I mean, I was just kind of when we got this rejection yesterday, I was thinking like we'll probably just trend kind of down into the middle of this thing somewhere today. Um, Now it looks a little bit, yeah, with that candle and the yen, this looks a little bit more downside. So that's kind of a thing to watch. I guess there's three targets to the downside if we start moving down. I mean, just do we make it out of this area here? Can we get across this big momentum line? And so this is the 120-day moving average here. And so the 120 is a moving average that, well, nobody else really uses, but I use it. I like it a whole lot better than, the if you use something like a 20 or a 50, it just kind of hugs the chart really tight where you can't really see any kind of long-term trends. And then if you go out to the 200, it's separated so far out of the chart. I mean, it's a good indicator of whether you're sort of up on a bull side of the chart, like a bull market side of the chart, or a bear market. And so for the 200, I mean, we're up on the bull market side of the chart. And so this is a really tricky spot to be, because we have like the volatility is really high. It's like a bear market level of volatility. So the fundamental, I mean, the PE ratios and the recession and everything, like all the fundamentals are super bear market, and the VIX is dangerous bear market territory. But we're on the technicals, we're up here in the bull area. We have bullish long-term momentum. And so there's a big conflict between the technicals, I guess, and the fundamentals right now. And everybody kind of knows that, but I guess what we're looking for is a spot where things start to make sense because there's so many conflicting signals. And the really cool macro theories, if you listen to like Lynn Alden or you listen to Brent Johnson or Luke Groman or like Jeff Snyder, talking about the international monetary system and how the currencies relate. The US currency is the backing of the whole world currency system. And the rest of the world is basically in a depression now, and the US is in an interesting spot because the dollar backs the entire world monetary system, and then US can print the dollar. And so, the US can print, so the default thing that people are saying is like inflation, and inflation will, drive everything up. It'll drive the dollar down, and it'll drive everything else up against the dollar. But it's not quite that simple because the other currencies can also print. And so the other countries, if they want to decrease their dollar, I mean, they have debt in dollars. If they want to pay their dollar debt, they can just inflate their currency, and they can inflate faster than the US can because they have a tiny fraction of the world currency supply. The US is like 70% of the world currency supply. So, I mean, it looks crazy for the Fed balance sheet to go to 7 trillion, but that's 7 trillion versus the entire world monetary supply, which I've seen estimates. I don't think anyone really knows the number, but I've seen estimates between like 70 trillion and 120 trillion as how many dollars are actually in the world monetary supply. And so, that's like, less than 10% of the world monetary supply. And it's not like they printed all that 7 trillion like out into circulation. Like that goes onto bank balance sheets, and they did do stimulus checks, but it was in the billions, couple of billions. Not It's not like $5 trillion went out into helicopter money and is just circulating or something crazy like that. Um, yeah, but that's the stuff to look out for this week, I guess, is the liquidity. A lot more than the fundamentals, because we know there's a fundamental disconnect, and we don't know when that'll kind of reverse. Like there, if you look really long term, like at some point, fundamentals will matter again, but that doesn't matter right now. Like if this thing turns into a big bubble, I mean, you can get a lot farther away from the fundamentals than we are right now. Um, so I mean, yeah, if this stock market turns into a real bubble, like like Bitcoin did or something, like I guess that's possible, and there's an upside target. It's just way up. It's way up if this thing does turn into like a real bubble. But right now, we just got kind of capped in normal kind of territory here. So this thing doesn't it doesn't look bubbly to me. Yeah, my outlook now is that what even is my outlook right now? I still have a bear market model on this thing, and we're still inside of the bear market model range. And so I don't know if I think this thing's gonna let me think about all the indicators. Yeah. I think this is still a bear market reversal point. I think that's what's happening. But there's no indicators saying that we're in a bear market now. I'm just looking at a reversal point, and this could be a reversal point on its own. Quite often, you get a double tap on the bottom side of one of these long-term trend lines. And in a bear market, let me zoom out and just kind of show the bear market scenario. Let me show both kind of scenarios. But right now, the interest rates and the helicopter money and stuff like that aren't looking extreme enough to shove this thing into like hyper bubble territory. Because the Treasury General account has like $1.5 trillion or more than that. I think it's like 1.6 trillion right now, and so that is money that can be spent straight into like helicopter money, and that's way more. That's way more spending money into the economy than we got from the last round of stimulus checks. So if they start pumping all of that money, like trillions, from the Treasury General account, out in the form of stimulus checks or like this infrastructure bill, they have several things in Congress right now. Um, yeah, so people are saying that that Treasury account is supposed to, blow up the market and stimulate the economy right before the election. Yeah, maybe. That's not really the look that I have. Like I'm looking at the where the interest rates are trading and the bonds are trading. So let's look at that. Let me draw this and then I'll look at the bonds. But generally in a bear market, you get your peak, right? And then this is a high level or a high angle. It's a bull market support line that comes off the 2018 crash, and so that supported this run here. And so we've broken this thing, and back tested it, and now we swung all the way back over to it. And so this is a big reversal point for a bear market kind of unwinding. So I mean, this is a 40-year bubble. The whole thing, it started in 1982. The everything bubble is 40 years, and from the 2018 bottom, we have a big support line. From the 2008 bottom, we have a big support line. From the 2018 bottom, we have a big support line. And so what happens? This is a sovereign debt bubble. So you expand a currency, and then it kind of hits a wall, and that's what a bubble is. Like the currency hit its max expansion, and then the currency will do a contraction. And the shape that you get on the charts for that is you break a trend line, you back test it, swing out, back test it a few times usually. Usually you'll break and back test it immediately, and then you'll swing out and break and back test it once or twice farther out. And it could be a couple of months or a couple of years to kind of back test the line. And then if you're on the backside of a bubble, once you've broken away from that line, like you don't come back. Like that terminates this line. It's a tangent line of a wave, and that wave is over. And then you get down to the next bull market line, and you break it, and you back test it. So that's the idea in the bear market case is, well, we've just back tested this, and we didn't break down here. So if this was it, we should have been able to get down already. So the longer that we trend sideways, the less likely that we break down below this now, and the more likely that we're going to test it again and break down from up here. So yeah, maybe today's action is pretty interesting to see if we can get a breakdown right now, because the odds of breaking down have decreased a lot. Like the odds of breaking down here were pretty high, and then lower and then lower. The farther we consolidate across, the lower the odds that we're breaking down from right here. And so I have a bear market target up here of double testing this thing and then breaking below this one and then back testing it. Basically, that's kind of what I'm looking for in the bear market case. And then for the super hyper bubble case, like I'll be looking for the Treasury General account to just start pumping a ridiculous amount of money into the economy, and then that I mean would be not a bull market, like a boring bull market. Like I don't have any case where a bull market happens. Like I think we're gonna blow into like a bubble, like a real bubble that's just ridiculous, or we're gonna break down the bubble here. And we have extremely high volatility, so it's indicating big stuff, not boring sideways little stuff. And even you can see here the sideways stuff is pretty serious. They're big movements. So out here on the daily chart, this is Volmageddon here. So that, I mean, this is where the super long, 10-year bull market really, that's really where the bull market ended. Like once we did Volmageddon, like we got into this crazy zone of high volatility and things are choppy, and it's expanded to the point where it's already pretty ridiculous. I mean, this crossover is not ridiculous, and this kicked the volatility, but this reversal in V was crazy. This was big, and this is the kind of rare case where you go into a higher level bubble trend line here, but now we've done this crash all the way across the zone. Now things are absolutely ridiculous, and this is the craziest market ever. And so yeah, so I guess, yeah, just the bear market case is that we just break the trend line, back test it, break the trend line, back test it. And then there's a floor down here. It's around 12 or 13 or something. And this is where the 40-year trend line supports the bottom of the everything bubble. So the bear market target is down here on this trend line. And then after that, you could, who knows, like Japan went into a bear market under their bottom on the Nikkei bubble. The Great Depression kind of dipped and then went into a higher level trend line afterwards. So once you get down to the actual floor of the bubble, once you've unwound the whole bubble, pretty much anything can happen after that. But that's just the general case for unwinding as a bubble, is you just back test, go down to the next one, back test it, go down to the next one. So we're still in that model. We haven't broken that model. But in the event that we do break that model, if we get up here above these trend lines and we break out of this bear model, then we're in this, I guess we call it the kangaroo model, where it's chopping kind of sideways with huge volatility. And this is the range we're chopping in. And so if we go hyper bubble, I mean, we have this range, this top edge of the range here to aim for. And it's not too much higher than we are now. So yeah, I guess we just really don't have the indicators to pick a model from here to guess what's going to happen. Like there's a couple ideas of what could happen, but we don't have things lining up. Like the bond rates have not traded negative. They're starting to steepen slightly in positive territory, which does not indicate either of these things. It's just like sideways, and that's what it's doing. Um, yeah, because I mean, for the big inflationary model, like you would see inflation go up, you'd see the interest rates start going up. You know, you'd see the general treasury account just pumping money into the economy, like big inflationary signals. And then the stock market, it would make sense for the stock market to just shoot up like crazy. Or if the bonds trade negative, then it would make sense for the stock market to kind of unwind this way in a sort of deflationary scenario. But yeah, I mean, right now we don't have the macro signals kind of lining up in a way that says we're in either of those conditions. Like we're just kind of in the middle of nowhere, just like doing nonsense right now. So that's the thing to look out for. And yeah, today looks just on the daily kind of stuff. You know, this is not investment advice. Today looks kind of weak. It just looks like a weak day in this range that we're in here. And yeah, if we don't break down now, if we don't break down now, I'm going to have a target up here for a bear market or a bull market case. It's already kind of running out of steam to do the bear move from here. But yeah, so this is an interesting area because this is a spot where you could get a big bear market reversal, or this is where you could actually break out into the hyper bubble bullish crazy nonsense case. And so hopefully over the next couple of weeks we'll get macro signals that line up in a way that makes sense to position some stuff. But yeah, just as for today, the yen broke down already, and so that is weak. That's weak for the where are we on the daily? Oh yeah, just this candle yesterday, and then you know DXY is maybe making a little move up, and the S&P is maybe making a little move down here, and so that we have the momentum just for kind of a weekday today. Oh yeah, what's gold doing? Gold was looking to break out a little bit. Okay, yeah, gold's still going up. So gold may be doing a little breakout move here. And so I guess on gold, well, that's not a great spot to buy like on a move like this. You know, you want to buy either at the bottom edge of the range or the middle of the range when you start seeing momentum. But for a buy spot for a gold breakout, I guess you want to see that gold does actually get out of the range and then kind of back test the top of the range and then the next momentum swing up, maybe another spot to position into gold to see if it does that. And yeah, gold could relate to the movement of the S&P. So if the S&P does break down, gold has a high likelihood of breaking down with it because these are big international monetary system liquidity kind of things. And gold sold off huge with this one, and another down move could get another down move in gold. That's typically what the monetary assets do in a down move is they'll sell off during the down move. But gold is high probability of rebounding huge after a down move, like right away or even before it finishes. So yeah, gold's an interesting one to watch, but not really a leading indicator. But these currency pairs are more important, kind of as a leading indicator, and then just the liquidity, I guess, on the liquidity outlook. Um, the Fed balance sheet 2 weeks ago flattened off completely. They stopped buying, and then last week they still are not buying anything. And I know everyone's saying they're buying tons of bonds, and they announced all this stuff, and the Fed's propping the market and going crazy. And if you just go to the Fed website and look at their balance sheet, and you zoom in on the last couple of weeks, that's a complete lie. They're not buying anything at all. And they're actually taking money out of the repo market. The Fed balance sheet has started going down as of last week. It's not going up. They're not doing QE. As of the last 2 weeks, the QE infinity thing, not happening. So I want to see that balance sheet update this week. and see if it's still, if it's down or what. Yeah, like right now it's going down. See if it starts accelerating down, then what everybody thinks the Fed is doing and what they're actually doing is dead opposite. Um, this week, I mean, back here they were blowing the balance sheet up like crazy and they followed through, but they've been tapering it down and tapering it down during this whole run. But starting in this area where this market has started to do weird stuff, they've stopped expanding the balance sheet. And that might have something to do with it. And so basically the Fed is taking liquidity out from their end. They're decreasing the balance sheet. And the Treasury is still increasing their Treasury General account, and that's taking liquidity out of the economy. Um, and that's what they do, every tax year. They take the taxes out into the general Treasury account, and then whatever additional money they want to spend, they, they sell treasuries, and the Fed buys them. The Fed, either the taxes or the Fed money just goes into the Treasury General account. But that account holds money out of the economy until they spend it in. And as of right now, Treasury is pulling money out of the economy from their end and holding it in that account, and the Fed is decreasing their balance sheet and pulling liquidity out of the market from their end. And it sounds like the international, like the European people are taking money from the US markets and moving it back into their markets. So the liquidity outlook looks weak for the stock market right now. And I think that's more important than trying to look at fundamentals or even technicals right now, because the technicals and the fundamentals are all just a mess. And they haven't been really correlating. They haven't been correlating with the actual stock market action very well. They just haven't been very good indicators over this crazy, whatever you want to call this market. But the Fed liquidity and the Treasury liquidity and the international movement of money in and out of the U.S. markets has really correlated well with what has been happening here. Because right here, the international banks and markets just sold. They sold U.S. assets and treasuries like crazy to get dollars to pay dollar loans. Like there was no liquidity, and so this is a huge liquidity squeeze across the whole world. And then here you get a huge reaction from the Fed, and and now the Fed's tapering off, and it's just kind of it's not a huge crazy thing like it was over here, but it's starting to reverse, and that's what the thing to look out for today. So it does look pretty weak on the liquidity outlook, and the high inflation indicators and the hyperbubble stuff is possible, but it's not happening right now. So so that's kind of the look right now. We're just kind of weak, just a little weak, and just waiting for some kind of indicator. I guess another thing to think about is on the liquidity thing is like the Fed. Well, I was looking at a thing from Lynn Alden like 2 days ago, and she was pointing out that the average income for America actually has gone up because people are getting their pay plus stimulus checks, and so the actual average income of Americans has actually gone up over what they're calling a mini recession or something like that. And so that's an interesting thing. And I don't know if that can continue or not. Like the dollar amount of income is more since people have not been working. But the balance sheets of the companies and the debt and the people's car loans and house loans and school loans and everything, like those have kind of been pushed off. People have not been paying their loans. People have been saving money, not paying their loans, and putting some money in the stock market, and nobody's producing anything. And so, that's kind of the thing to look at too, is sort of the PPP loans are expiring this week or next week, and that was the government paying companies not to lay people off, and so that ends, and so people can start laying people off again. We'll see what the unemployment rate does when that happens, and then one more month, and the stimulus that is added to the unemployment would end, and so the average pay rate of everyone would go down into negative, negative from the average at that point. So we'll see if they extend well, they probably won't extend the PPP because that's a date for the businesses to have their grants mature or whatever, their PPP loan grants mature. Um, but they have a ton of stimulus bills in the Congress, and the last stimulus bills correlated really well with this crazy run. And if the stimulus bills cut off and they're not issuing any new stimulus, then that's a huge thing to look out for on the liquidity part as well. And so that should play out over the next 2 or 3 months as the programs that they have in place are ending, and we'll see what new ones they do. And so they've been talking about doing them, and they certainly have the funds ready to do them because they have whatever it is, 1.6 trillion in the general treasury account. Like they could issue that stuff overnight. I mean, hopefully we'll get to see the bills pass and it's not a surprise. But yeah, if they do a bigger liquidity helicopter money thing, that's definitely something to look out for. And that's kind of it. So what was this? American Airlines? Yeah, so American Airlines is one of the huge ones on my bankruptcy solvency playlist, watch list, because they're doing every single thing that you can do that's risky or kind of bad, leading to a bankruptcy situation. They're issuing new shares, diluting their stock. They're issuing bonds, and the rate of the bonds keeps going up, and they keep issuing more bonds, trying to raise cash, and that's just cash to burn while they're not operating. They're downsizing their fleet, and they're selling off assets. Like those are all bankruptcy indicators, and yeah, and their book value is negative. Like their assets are smaller than their long term kind of assets are smaller than long term liabilities. So they're just burning everything. They're just burning cash, and if they declare bankruptcy, the equity value is zero because they have no assets. It, any money available just goes to the debt and the bondholders. Um, but yeah, as of right now, it looks like they're raising enough cash to stay solvent through the end of the year, roughly. So that'll be a thing to check out. And then if they go bankrupt, then right, the stock will probably like shoot up like Hertz, right? So what is the stock gonna look like while they're going bankrupt? I don't know if that automatically makes it a good short. Like it should be a good stock to short. But this stuff has been so crazy. Bankrupt companies are going like 10x. Oh yeah, but on Hertz as well. I don't know if everyone heard, but the SEC stepped in and prevented Hertz from issuing new shares after the bankruptcy, which is pretty ethical and good thing for the SEC to do. It kind of sets a precedent that they are, well, keeping Hertz from just stealing from everybody. Because I mean, issuing new shares during a bankruptcy is just you're just taking a bunch of money from new investors with zero intent of doing anything but just paying your debt and your bondholders off in the bankruptcy, and then the equity value is worthless. It's just a scam. It's just theft, and the SEC stopped them from doing it. Um, so that's a cool thing to see. I was really surprised that they did that. I think that's good. Um, yeah. So let's see if liquidity maps to the market over the next week or so, and see if there's any kind of correlation between reality and the stock market that starts happening, or if it just gets more ridiculous. Because it's crazy. Everything's just absolutely crazy right now. Yeah. So happy trading, and beware of the airline stocks right now, especially with the potential of more lockdowns. the airlines are trying to operate at minimal capacity now, and if travel and everything gets locked down more, that's more risk for them. And I have heard the government mention that they are going to issue domestic travel credits or something like that. Like they're going to give people money to spend on like air travel and hotels, like a different kind of helicopter money. I think they're actually going to do that, which is really interesting. And so well, I mean, that's kind of a cool way to sort of bail out companies, I guess, because instead of just behind the scenes, just kind of dumping money in their accounts and just burning it, like you're giving the money to people to actually use the services. So the economy actually functions. It's like a different way to try to do the bailouts, I guess. We'll see how that goes. There's some weird stuff going on. Cheers.